The stock we are analyzing right now is Plug Power Inc., ticker symbol PLUG, currently trading at $1.93, up 0.04 cents or 2.12% on the day. While the market is currently closed for the weekend, this Friday closing price represents more than just a ticker flashing on a screen. It represents a battleground between the remnants of a retail investor dream and the harsh, cold calculus of institutional balance sheet restructuring. If you are looking at this green percentage and thinking the bottom is in, you need to pause and look closer at the machinery grinding beneath the surface of this equity. The expectation for Plug Power has always been binary. Either it becomes the ExxonMobil of the green hydrogen economy or it goes to zero. The reality, however, is far more nuanced, painful, and technically complex. The reality is that this 2% move is happening in the shadow of a massive liquidity event that has fundamentally altered the capital structure of the company. A detail that most casual observers using a Robinhood app or checking headlines on SoFi Invest might miss if they are only looking at the daily percentage change. Let us bridge the gap between what the market expects and what is actually happening. The general consensus, the expectation, is that Plug Power is currently a broken stock, battered by high interest rates and a souring sentiment on green energy projects that require massive capital expenditures. Investors expect that the company is simply burning cash with no end in sight. The reality, however, forces us to look at the specific mechanics of their recent survival strategy. The recent price action isn't just volatility, it is a reaction to a $375 million convertible senior notes offering. When a company at this price level issues convertible debt, it is often viewed as a desperate gasp for oxygen. However, if you dig deeper into the terms, a conversion price significantly higher than the current trading levels, you realize that the institutional investors participating in this offering are betting on a recovery, not a bankruptcy. They are effectively buying a call option on the company's survival. This creates a massive tension. The retail trader sees dilution and fear, while the credit market is pricing in a structured, albeit risky, path forward. This divergence is where the opportunity for analysis lies, and it is what we must dissect today. To understand why Plug Power is trading at $1.93, we have to look at the immediate history of the last few trading sessions. The volume we are seeing isn't just retail buy-the-dip enthusiasm, it is a churn of positions as the market digests the implications of the U.S. Department of Energy loan guarantee situation. For months, the expectation was that the DOE loan of over $1.6 billion would be the silver bullet that solved Plug's liquidity crisis. The reality, revealed in recent filings and management commentary, is that Plug has suspended activities related to this loan due to the shifting political landscape and the incoming administration's stance on green energy subsidies. This sounds catastrophic, and the initial market reaction suggested it was. But the counterintuitive reality is that unhooking from the bureaucratic delays of the DOE might allow Plug to move faster, albeit with more expensive capital. This pivot is what is driving the current volatility. You are seeing a repricing of the company from a government-subsidized project to a market-rate survival story. If you are holding Tesla stock or have been watching the meteoric rise of Nvidia stock, you are familiar with the concept of a story stock transitioning into a fundamental execution story. Plug is in the most painful part of that transition. The stock's movement this week has been characterized by high volume in the pre-market and after-hour sessions, a hallmark of institutional positioning. Interactive brokers data often shows that when retail investors are sleeping, the smart money is adjusting risk models. In Plug's case, the risk model has shifted from growth at all costs to cash flow preservation. The stock is hovering near historic lows, a psychological support level that, if broken, could trigger algorithmic selling from quant funds. However, the 2% bounce we are seeing today suggests that short sellers may be covering their positions, fearing that the worst news, the dilution and the DOE pause, is already priced in. This phenomenon, known as selling the rumor and buying the news, often traps retail bears who enter the trade too late. Now let's shift the focus to the actual business, because amidst the financial engineering, there is a physical company building physical things. Plug Power essentially operates in the hydrogen fuel cell ecosystem. Their business model is built on creating an end-to-end green hydrogen network. They don't just sell the fuel cells, the engines that run forklifts and backup power systems. They also aim to produce the hydrogen fuel itself through electrolyzers and transport it to the customer. Historically, this has been their Achilles heel. They were buying hydrogen on the open market at high prices and selling it to customers like Amazon and Walmart at fixed contract prices, effectively losing money on every kilogram of gas dispensed. This is why the cash burn has been so horrific in the past. However, the recent quarterly reports show a distinct shift. They are bringing their own hydrogen production plants online, specifically in Georgia and Tennessee. The Georgia plant, despite its delays, is a critical piece of the puzzle. As they ramp up internal production, their gross margins on fuel should theoretically flip from negative to positive. This is the fundamental reality that the bears might be ignoring. If Plug can produce hydrogen for $3 and sell it for $6, the entire economic model changes. We must also discuss the electrolyzer business, which is the machinery that splits water into hydrogen and oxygen. While the fuel business has been a drag on earnings, the electrolyzer sales have surged, up 46% sequentially in the last quarter. This is a high-growth hardware segment that competes directly with legacy energy tech. If you are looking for investment help or browsing investing sites, you will often see Plug categorized strictly as a green energy play. But management is actively trying to rebrand the narrative towards the AI power crunch. Data centers, the massive server farms powering the artificial intelligence revolution, require uninterruptible power supplies. The grid is increasingly unstable. Plug Power is positioning its stationary fuel cells as the clean backup power solution for these data centers. This is a strategic pivot designed to align the company with the momentum of big tech, moving away from the purely legislative tailwinds of the Inflation Reduction Act and towards the private sector demand for energy reliability. However, we cannot discuss this stock without addressing the elephant in the room, the balance sheet. As of the most recent reporting, Plug ended the quarter with roughly $166 million in unrestricted cash. For a company with Plug's operational footprint, that is a razor-thin margin of error. It is the financial equivalent of driving a Formula One car with the fuel light blinking. This is why the convertible note offering was necessary and why the stock dropped 16% on the news, before stabilizing. They are raising cash to pay off older, higher-interest debt and to keep the lights on while they wait for their hydrogen plants to reach full capacity. If you use Fidelity Wealth Management Services or have a Fidelity brokerage account, you know that advisors typically warn against companies with this kind of cash runway risk. It is speculative, it is dangerous, but it is also why the upside potential exists if they navigate the liquidity crunch. The company is executing Project Quantum Leap, an internal initiative to slash costs by hundreds of millions of dollars. They are consolidating facilities, reducing headcount, and optimizing their supply chain. The success of this project is not just a corporate goal, it is an existential necessity. I want you to take a moment right now and comment below. How many shares of Plug Power do you currently hold, and what is your average buy-in price? Are you averaging down at these levels, or are you waiting for a clearer signal that the cash burn has stopped? Also, do you believe the AI data center narrative is a real revenue stream for them, or just a buzzword to keep investors interested? Let me know in the comments. Continuing with the analysis, we have to look at the macro environment. Interest rates are the gravity that holds stocks like Plug Power down. When the Federal Reserve holds rates high, the cost of capital for building hydrogen plants remains expensive. This hurts Plug in two ways. It makes their own debt costlier, and it makes their customers hesitant to invest in new hydrogen infrastructure. However, as we look towards the future outlook, any signal of rate cuts could act as a massive catalyst for this sector. Furthermore, the Trump trade narrative that hurt the stock initially might be more complex. While the new administration may be hostile to direct subsidies, they are generally favorable to industrial onshoring and domestic energy production. If Plug can frame its hydrogen production as American-made energy independence, they might find a political lane to survive, even without the DOE loan. Competition is another vector we must consider. Plug is not alone. They are fighting against Bloom Energy, which uses solid oxide fuel cells and has a stronger foothold in the data center market already. They are competing with Ballard Power Systems in the mobility sector, and they are competing against traditional battery technology. The argument for hydrogen has always been energy density and refueling time. You can refuel a hydrogen forklift in 2 minutes. Charging the battery takes hours. For high-intensity logistics operations like an Amazon warehouse, that uptime is worth paying for. This is Plug's moat. Their Gen-Key turnkey solution is sticky. Once a warehouse is retrofitted for hydrogen, it is very difficult to rip it out and go back to batteries. This customer retention is a hidden asset that doesn't always show up clearly on a balance sheet, but provides a baseline of recurring revenue. Let's look deeper into the Project Quantum Leap and what it implies for the next 2 quarters. The expectation is that Plug will continue to post losses. The reality we need to watch for is the rate of change in those losses. If the cash burn drops from $200 million a quarter to $100 million, the market will reward that improvement significantly. This is a game of derivatives. Investors are looking for the second